It's my first year here.
On time.
That's my kind of show. I like an on-time show. We have a rule in our management team at Groundfloor that we meet once a month, and it's extremely expensive time. You're top managers in a room, and we use the Barack Obama maxim, which is attributed to him, which is if you can't be on time, you're we started instituting a fine system. It's good. We actually donated to a couple of campaigns on Kiva last week with fines. They were like $5 a minute. It was not so big. Before we get started, full disclosure: who here is already a private lender? A good number. So you'll check me on your own experience in private lending, and I can't wait to hear your questions. We're gonna have plenty of time for questions. In fact, we're gonna have a way to make this a little more interactive and see how that goes, so that we're not talking at you. To that end, we've got 4 panelists. I'm gonna start off our session by giving you a quick overview of the session and sort of what we see about the private lending market and some of the opportunities that are emerging in it. Some of you may know about this stuff, some of you may not. But we'll establish that as groundwork. And then we have 4 guests who I'll introduce in turn as we get to them. And I have a question that's pre-planned for them just to get things rolling. And then there will be a chance for all of you to ask us all questions as well. So let me introduce myself. Put this thing to work. My name is Brian Dally. I am co-founder and CEO of Groundfloor. Groundfloor is a 50-employee startup, venture-backed startup in Atlanta, Georgia, down in the heart near Georgia Tech, where we spent many of our early years. We have been lending now for 6 months and enabling thousands of individual investors to lend in private markets as well now for 6 years. Happy to share a little bit more about that in just a second. If you have questions about anything I've said in your text-oriented, like a lot of people seem to be these days, feel free to send me a text at this number, and when we're going through the panelists, I'll organize these questions. If there's a flood, I probably can't handle it, but if there's just a few, we'll get it, and I'll order the questions and sequence them. And don't worry, this number is, I'm an audience-friendly speaker, so this number is on subsequent slides, so you'll see in just a minute. All right. Here's what we realized 7 years ago, and it's a travesty. It's a travesty that means that people don't save enough money. When they do save enough money, they don't feel too good about it, and they often take on too much risk. Over 90% of individual investors are on the sidelines when it comes to private market securities. Now, for some of you who are lucky, you're accredited investors, you have access to these securities. You probably have a guy that sends you a PPM every once in a while, or maybe you stacked up some capital and you're out lending it yourself or investing it directly yourself, and that's great. But that's not true for the vast majority of people, and that's why we created Groundfloor. We created a publicly available security that's qualified by the SEC that allows everybody to participate in the sphere of private lending $10 at a time, without giving up control, without giving up their agency. I mean, if I told you that you could participate in the stock market, if you only do it via an index fund or a mutual fund or something I had for you that was a fund, you'd look at me like I had 2 heads, because you want to buy, depending on the week or the quarter or the day, you might want Tesla or Uber or Facebook, and you might want to trade, you might want to buy and hold, and you want your own strategy. That's not accessible to 96% of the people in America, because they don't meet the definition of the accredited investor. All of these people. Now, the consequences of that are important for saving and investing. I saw that there's some high school students who are attending for MoneyShow University, which is really cool. They are definitely not accredited investors, but they need to learn about investing. And ideally, they would learn about lots. Hopefully, they're not just putting it all in Bitcoin, right? Volatile, who knows what that is. Hopefully, they're putting in something, a diversity of assets. When I was 15, I started investing in mutual funds, because my dad sent me to the library back when you had to do that, and I had to go look up Morningstar and learn about mutual funds. And he said, look, $30 you earn cutting grass or working in a store, I'll match your dollar. And by the time I went to college, I had a pretty good bunch of money, because that was, I'm old, relatively. That was the late 80s, which is a great time to be entering the market for the first time as a high school student. So we are here to take that problem and solve it. But there's another problem that's hidden, which those of you who are accredited investors know, your securities, the issuances that you're participating in are frequently unregulated, not transparent, and you don't really know what's going on. Wouldn't it be great if private market securities had the same protections and disclosures that public market securities have? That's what we're really interested in. Now, we had to find a market when we were a startup that people could understand, that people would actually buy, and we found short-term, high-yield residential real estate debt. That's an example of private lending. Those of you who've been in the business know that you can private lend on lots of things. It doesn't have to be residential real estate. You could lend your money in storage facilities. That's a great investment out here. I saw a guy speak earlier about oil and gas and mineral deposits. You could lend in that market. There are a lot of places you could lend. We started with real estate because we think a broad number of people understand at least residential real estate. You watch a house flipping show, 2/3 of us own a house at some point in our life or at any given time. And we wanted it to be something that people could understand and that was tangible. So we started here, but I think this is going to happen in a lot of markets. I think this change is coming to a capital market near you in lots of sectors. There are startups working in many different areas to do this. There's energy funders, there's minerals, there's a lot of places. We're just the first one and the only one so far that's actually qualified this as a publicly available security. So this is kind of what it looks like. This is a screenshot of our loan page. You can see here there's a bunch of loans rated A through G. These happen to be all B's and C's. You can see where the loan is. You can see what the rate of return is. 9, 10, 12% is typical. You can see what the term is. It's maybe 12 months. You can see how much leverage is on it. You can see some other facts and figures, and the loans are usually pretty small. We'll put about 800, 1,000, 1,200 investors into these loans. And the best part is, for you as an investor, you get, this is a look at a dashboard, and what it might look at. You will have, by the time you're done investing over time and putting money to work, you'll have hundreds and ultimately thousands of investments. Normally, a problem in private lending, if you know how to do it, is you're over-concentrated in the assets on which you're lending. Now, it's good to be a lender. We're going to talk about that in a minute. Why lending as opposed to equity investing? This is a gap in most people's portfolio, and what we're trying to do is give you access to it in a way that doesn't require that you write checks of $50, $100, $150,000. You can transfer in $10 and get started. If you have $1,000 and one of those kids that are in high school earns $1,000 in the summer, he can be as well diversified as most private lenders I know who are in the business. They have 100 loans, just $10 a loan, but earning the same yield. That's what's happening in private lending. We're going to talk about it. Now, we have 4 panelists with us. I'm about to introduce the first one. And as we go, I'm going to ask them to give a brief intro about themselves. I'm going to tee up a question for them to answer, which I did give them in advance. It's not a pop quiz. And we're going to move through and talk about private lending and how it works. I'm going to check my text and see if I have questions. I don't. Okay. All right. So first, let me introduce Andy. Andy Piedra. Andy is a borrower with Groundfloor. He actually uses private lending money. He became an investor in Groundfloor as well, and he has quite an interesting story to tell. Now, Andy, tell us what about the private lending opportunity in real estate? What is this? As a guy who's borrowed money, as a guy who's done this and used the money.
Yeah, full circle on that. So, hi, I'm Andy Piedra. I didn't realize I was going to have my own slide here, so that's kind of cool. Yeah, I was in the Air Force for 8 years and then continued on for another 10 years with the Defense Department as a civilian. While I was doing that, I realized when you're in the Air Force and working for the government, you're never really going to get loaded, right? I didn't get paid very much working there. So I got interested in real estate. I moved to Washington, D.C. and created my own real estate company with military veterans all in the company, and was having fun with that. And then I started flipping houses and buying houses to rent out. And when that got more difficult in the area in which I lived to find those deals, I couldn't figure out where to put money, and I was not accredited yet. So I started searching around and I found peer-to-peer lending sites, but you had to be accredited. You had minimum $50,000. Like, well, how do guys like me? How do we become accredited? So I ended up finding Groundfloor after I was doing peer-to-peer lending on other sites that were backed by essentially nothing, backed by a promise, $25 notes, 300 people funding the loan, and they immediately default, and you're out because it's just a promise. The threat to them is your credit score might go down. They don't really care. So when I found Groundfloor, it was an instant, light bulb moment for me. I opened the account with probably $100, maybe $200, and then started doing $10 on these different projects. You just saw one on there that said 680 people. I'm one of those people. I put a few bucks into that house. And once I realized that this was actually working, that it wasn't just lip service, I started putting money in for the last 4 years I've been doing it. And then eventually I used Groundfloor to flip a house because it was better than the loans I was getting on the regular market for the house flip. And in fact, my nephew opened an account and he actually funded $10 worth of my flip.
Did he call you when it was late?
He called me before he did it. He wanted some insider trading information. Is this gonna go well? I'm like, yeah, buddy. We're gonna close this deal. Don't worry. And one of my passions, when I graduated high school, I immediately went into debt because I had no idea about the value of the dollar and how to manage my finances. So my passion now is to teach young people. So my daughter's friend works at a fast food restaurant, and she's working her tail off. And I showed her just with compound interest. That's what excites people. That's what excites kids. And I showed her, if you start with $500 and you only put the $200 in that you're making from Arby's, it's really good. I don't know if you like Arby's, but that's where she works. You do that every month. You just add in $200 for 55 years, nothing else, and you follow the rate of return that I'm getting on Groundfloor, which was higher than the 9.6. I think you showed up there. 9. Probably, yeah. You working at Arby's after 55 years, you have an account that's worth $4.5 million, and that's just the power of compound interest. So this is a young person's game for the long term, and so I'm getting them involved, teaching my daughter's high school this concept next month for the class because it's important that they do that early on. And this platform is the only one that I can find where you get to invest your money and you can get a much higher interest rate than you would in your savings account. You can enjoy doing it. I love looking at every single one that I want to invest in. I don't even look up the human being behind the LLC and see if I can find them on Facebook. That's how into it I get. And you don't really get that elsewhere. You're not just throwing your money in blindly. You can if you want to. Passion is what grabbed me. And because of it, I'm now an accredited investor thanks to Groundfloor assisting. So it's something that I believe in, and I only work with companies that I believe in. So that's me.
Great. Thanks. We have panelist number 2. And queue up your questions because we're gonna get a chance to get to all of them. Panelist number 2 is Adam Bergman. See, you have a slide too.
Yeah.
About that. Not your favorite picture?
Yeah.
Yeah, I like it. That's really good. We'll improve next time. So Adam is an expert in self-directed IRAs, which, there's a lot happening in that world if you're not familiar. It's a really exciting kind of area. So I wonder, Adam, if you would mind introducing yourself and tell us why self-directed IRAs are so good for investors and how they're using them to participate in private lending and other opportunities, but not long-term.
Sure. Okay. So my name is Adam Bergman. I am president of IRA Financial, and I'm a former tax attorney. Written 7 books on retirement accounts, self-directed retirement accounts, and obviously the main reason someone wants to use an IRA or 401k to make an investment is deferral, tax deferral, and in the case of Roth, tax-free growth. So compounded interest, 8th one in the world, your money doubles every 8 years, you get 8%. Simple math. High school kids understand it. Unfortunately, most Americans never heard of it. I guess the issue with our education system, but it's great. Yeah, it's great what you're doing. It's really important. So just full disclosure, I can't endorse any investment. I own a trust company, so we're a non-fiduciary trust company. We administer all types of IRS approved investments. So just to be clear, I'm not sitting here endorsing any investment. The advantage of using a retirement account to make private lending investments is very specific and clear. It's the ability to generate the interest from the investment without tax. And unlike certain other investments, some capital gain investments, some investments involving leverage when you own real estate directly, when you are a lender, the interest you receive is exempt from tax under 512 of the Internal Revenue Code. So it's a very smart, safe way to use an IRA. Okay, it's also very passive, which is great. Less chance of getting a prohibited transaction, which is a transaction that will either serve as a collectible, life insurance, or self-dealing, where you're investing in your own personal flip, for example. And in a setting like this, it's very safe because it's a platform where you're dealing with third parties, you're not dealing with related parties, you're dealing with people all over the country, you're taking a very small slice of a loan, so you get really diversification, you are passive, you're not actively involved in the underlying real estate project, which is very important from a prohibited transaction standpoint. And you can get into the investment for a very low amount of money, which is important because one of the issues we found in the self-directed IRA world over the last, say, 2 to 3 years is that with real estate appreciating all over the country, and with the average IRA being around $225,000, if you want to buy an asset, a real estate asset, it's very difficult. I mean, there's not a lot of really good opportunities, or not as much, I should say, as there was in 9 or 2010 or even 11 or 12, because of the appreciation of the real estate market. So companies like Groundfloor, where you can get in and have a chance to see a whole selection of properties all over the country, assets that you probably would not have exposure through, and be able to invest in a retirement account without paying tax is exciting and very valuable. And I do believe that these types of investments are the future. I think it's really important, especially for millennials, Generation Xers, who want to get exposure to real estate, want to get exposure to good assets, but don't have the money because they're saving. It's still a long process. One of the issues with retirement savings is it's trusting the process. It's not a quick, rich game. So when you talk to someone and say, why aren't you saving for an IRA, in an IRA or 401k, the answer, unfortunately, you get is, well, I can't touch it. I can't use it. Well, right, that's not the point of it. You're not supposed to use it. You're supposed to have it for your retirement account. But unfortunately, a lot of people just want instant gratification. They want to grab that money, go buy a car or go on vacation, and that's really not the purpose of a retirement account. It's permanent. It's supposed to be for the future. So, to generate tax deferral or tax-free growth in a Roth IRA, for someone who's young, I would say, hey, maybe open a Roth IRA, put $100, $200 in, buy an S&P 500 fund, and maybe you want to put $100 in a real estate lending platform and diversify. So it's a really, I think you got a really exciting platform. I think this is the future. I think you're going to see a lot more, as you mentioned, industries where they're going to basically allow investors to have a slice of some really cool assets.
Cool, thank you. We have been dabbling for the last few years in self-directed IRAs. They're incredibly popular and becoming easier to set up and manage too. So for people who are interested in that, I'm sure Adam has some questions and guide you. Or buy his books. Yeah, that's what I would do. Right.
Free.
Oh, they're free.
For you guys, free.
Well, next up, I want to introduce our third panelist, Rich Polito. He is Senior Vice President of Lending and Risk Management at Groundfloor. Now, as a startup, one of the problems, when it was just 2 or 3 of us back in Raleigh, North Carolina, one of the problems is, you don't really have all the expertise you need. And it turns out, in order to make good real estate loans, or good private loans generally, you really have to know what you're talking about. That was a challenge for us in the early days, but not when Rich came on board. Rich had joined us after a multi-decade, 27-year career at Prudential. And the assignment that we gave to Rich, that he's going to speak about here in a second, is we said, look, Rich, I want you to help him build this company. It's a crazy little tech startup. Fortunately, he was game for that and all that it entailed. Been with us almost 4 years now. I said, what we want to do is we want to take the rigor that you use for an $80 million loan or a $50 million loan, and we want you to apply that to these $80,000 loans. Could we do that in some form? Because if you're going to offer something to the public, it better be good, right? If you're gonna do it at scale, and you wanna avoid the plaintiff's lawyers and the class action lawsuits and the disappointment of people with pitchforks, you better know what you're doing. So Rich, if you would take a few minutes to introduce yourself and tell us, when you think about it from your career in real estate and looking at all the market cycles that you've seen across these different asset classes within real estate in particular, what are the benefits of lending versus investing as an equity investor? We're talking about private lending.
Yep, sure. Happy to do that. The first thing I want to say is my fine total at Groundfloor for being late is 0. Right? So good discipline from the person responsible for risk management. Yes, as Brian said, I have been involved in commercial real estate actually for over 30 years, 27 of it with one of the 10 largest global institutions, real estate investors in the world. And when I talked to Brian, I said what I'd love to do, I love this concept, and I want to bring institutional rigor to this platform, to this program. And I think that's what we have done in terms of our underwriting, our processing, our asset management. And I think that has been really to the benefit of our investors if you look at the returns that we're getting. We actually just had a major Wall Street player come to our office, and they want to start buying our loans, and they went through our entire portfolio of performance, looking at defaults, everything, and they said, you guys are actually quite good, better than a lot of the other lenders they had talked to in terms of our performance. So fortunately, they're going to buy loans from us. But really, I think the thing that I want to focus on is what is the difference between debt and equity for you guys as being private lenders. A couple things. Number one thing that we like about, I think, debt is the priority, right? If you're in a first mortgage lien position, you get paid first. And the equity takes the losses. So I think people who are looking for some level of security like the priority. Number two is stability of cash flow. You get a fixed interest rate, so you have some idea of what you're going to get. On the equity side, depends on the performance of the property. If you're buying a little house, maybe you get the ARV that you expected, maybe you don't. If you're buying an income producing property, maybe you get the rents that you projected, but maybe you don't. But if you have that lien, you're going to get the first shot of cash flow. Stability of cash flow is a very positive thing for investors. Secured claim, right? If things really go wrong, there is something backing up your investment. You were talking about your early investments in other forms of crowdfunding, not secured. What did you look to? A promise. We look to a promise, but we also have a hard asset backing up. So I think that's something that folks very much like in terms of mortgages versus the equity, in terms of the risk factor. As an investor, also I think as a private lender, mortgages do a couple of things for you. They're easier, a lot easier. It's a lot easier to just give somebody a mortgage loan and let them go off and buy the property, renovate the property, lease the property, sell the property, whatever, and all you're doing is sitting back and collecting your coupons. I think there's that ease. Also, I think transaction costs. Sometimes it's, you guys have if you happen to have a loan in your portfolio, probably could trade that pretty easily at not a high cost. If you own a property, the transaction costs are involved in actually selling the property, paying a commission, transfer taxes, this, that, and the other. So I think those are some of the benefits of a debt instrument versus equity in the private real estate market.
Great. Thank you, Rich. One more panelist, and then we'll turn to questions. We are time check, we're 24 minutes in. We're going to be on time. It's an on-time conference. So I'm going to introduce Kelsey Young. Kelsey Young has been with us just a month as a customer success specialist, but she's gotten up to speed in the department of leveraging her training as a financial advisor before she got to us. And my question for Kelsey as she introduces herself and your outlook on this is, when people get started lending money this way, what kinds of questions, concerns do they express to you and the others who work in that customer success department?
Yeah, Thank you, Brian. As you said, I'm Kelsey Young. I recently started with Groundfloor, but my education was in financial planning. I graduated from the University of Georgia in their financial planning department. And my passion for that really came from a young age. I was very fortunate that my dad started educating me on saving and investing and compounding interest, as we were talking about earlier. And I realized through conversations with friends, even in middle school and high school, they had no idea what I was talking about, weren't thinking about saving at all. And it occurred to me that our education is so lacking in that. We don't have any education for our high schoolers, for middle schoolers, for college students even, in financial planning. And so through conversations with friends, family, I worked with a financial planning firm for a few years before coming to Groundfloor, and now I work in our customer success team. So I get to work with our investors on a daily basis, which I really enjoy. I love people, I love conversations, I love getting to help people. A lot of the main questions and concerns we get, Rich addressed some of those key points earlier. Just how is my money secured? What is it backed by? And on our platform, it's backed by that property, and we do hold first lien positions on each of the properties on our platform, and so that's always a great conversation to be able to have with investors in case of a default or a foreclosure situation. We have protections put into place to be able to help them with that. We have actually a blog on our website that goes into detail on multiple different aspects of how we work with our borrowers, what criteria goes into lending to someone, and then once that is qualified and put on our platform, why is it a 7% interest rate versus a 13% interest rate? What are the risk factors that go into this? And so we try to provide some of that information to the investors so that you can then choose and make your own assessment based on your risk factors and how you feel. But some questions we have are also on liquidity. People will come to us when you start saving at a younger age. Obviously, you have a longer time horizon to be able to have compounding interest with that. And sometimes we have people that are coming to us and say, I really do want to be able to earn these higher interest rates, but I might need my money within the next few years. And so with our platform, all of the loans are typically between 6 to 12 months. So you have the ability to then use those funds a little bit. You have that liquidity aspect with it. After a year, you can get the funds back, and you can then either choose to reinvest, or if life comes and you need to use that money, you have that ability rather than a 5 to 10 year investment.
Now, one thing you've heard about from a Groundfloor perspective and how we approach this market is some of the issues that I think you'll find in common with private lending generally. You got to find the right deals to invest in. You have to have a bunch of expertise in your local area, and you have to know what you're doing. You have to have the right documentation, process, and people behind these things. You have to manage these assets. Once you make the loan, you got to make sure that you get the money back. Somebody told me when I was getting into the lending business for the first time, they said, Brian, it's really easy to loan money out. And they're trying to dissuade me from returning the business. They said, it's a little harder to get it back. And so we have put a lot of work into that as in our private lending business. We have been, I guess, made better by the fact that the Securities and Exchange Commission requires us to disclose all of that. And I think what you're going to see in the market is more people in more markets, like residential real estate, start to offer those same types of securities. And maybe you're already investing in some of those. I'm curious to hear about that. So, any questions in the room by show of hands, and we'll go around. Yes, sir. You go ahead.
I invest in Pier Street.
Yes.
Your returns are 2 to 3 points higher than Pier Street.
Correct.
So that would seem to indicate more risk.
It would. So the question, in case people couldn't hear, is this gentleman invests in another platform called Pure Street. Pure Street, for accredited investors, offers these same types of loans. Their model is very different, though. He's saying, wouldn't that make it seem like these loans are riskier because the rates are higher? And truly, rates should reflect return. rates also reflect another factor, which is business model, and the way that people are buying these products. Pier Street has a couple of factors that are quite different from us. They buy from originators who actually do the origination. We're self-origination. So we originate every loan we make, we're involved in the origination. We talk to the borrower at the beginning, we take the application, we underwrite it ourselves, and then at the end, we're actually closing the loan, checking title, getting the title insurance, and then we asset manage it. In Pier Street's case, they're partnering with a local originator. And some points are lost there, and buyer beware. In fact, I don't think the rates of return that are offered on that platform actually reflect the true risk. But the real way that we measure risk is not the rates that are offered, but the rates that are delivered. So our rate of return over 6 years has averaged about 10.69%, and that's net of a loss ratio of about 60 basis points on average over time, which is a stellar record. The reason that exists, anybody who's in private lending knows why this exists. These people need the money, and they and the collateral generally are worth the money, especially if they can qualify with a loan with somebody like us. You know, we're one click away from being a community bank at the end of the day. So there is a market failure and has been since the Great Recession in this category, which is why the yields are so high. And then other platforms just don't have the same models of originating these loans themselves, and that accounts for the delta for the most part.
Hey Brian, I'd like to add
go
one
ahead.
comment to that. I actually am a Pier Street investor as well. I want to see what other people are doing. And their minimum is $1,000. So one of the key things that you could do, I think, that's different in Groundfloor is you can take that $1,000 and you can invest in 100 loans. And so just getting that diversification mitigated a lot of the risk. So you get the benefit of, as you said, A, higher yield, and B, the potential for broader diversification. Pretty powerful comment.
Having done both sides, investing in these notes and then also obtaining a loan for a flip, I did the investing part first. And then when I got the loan, a lot of the fears and uncertainties I had were mitigated by the gates I had to jump through and work through in order to get the loan. The underwriting was incredibly detailed, almost to the point where I was like, how long? Why is this worth it? It was fantastic because people are getting through, and now I know that it's a lot of these are very, very safe. Like it's the only investment I do where I hit enter, I'm not nervous.
Lots of questions. I'll go to the back first.
If there is a foreclosure, how do you handle that? Who pays the expenses and so forth?
So I'm going to turn that question over to our foreclosure man who carries the baseball bat, Rich Polito.
Yes. The answer to that is we do. We underwrote the deal. We know the borrower. We know the market. We know the collateral. And so we will go through the process. And just so you have a little bit of understanding, in my third-year career, I ran the workout group down through the downturn. So I handled about a $55 billion portfolio of distressed assets. So I've been through bankruptcies and foreclosures and whatnot a few times. But we handle it. And the way the cost works, basically, is we strive for obviously the highest recovery we can get on the loan, on the property. And then we net out our expenses, legal fees, transaction costs, whatnot, and the net is passed on to the investor. And I will note one thing, people often ask us about default rates. What's your default rate? And I'm really concerned about, oh my gosh, if my loan goes into default. One thing that's interesting, a fair amount of our defaulted loans, well, one, don't get foreclosed on because we always strive for some resolution other than foreclosure. And two, when we realize default rate, interest, it all goes to the investor. We don't keep it, it goes to you.
Defaults actually perform better than contract typically. Yes, sir. Yeah, you're good.
You started flipping homes and investing in real estate. Are you currently borrowing money from Groundfloor and investing in funds?
No, I did one flip loan through Groundfloor, but I normally do buy and hold. So for my buy and hold, I need like 15 to 30 year notes. These are maximum 1 year, right? 1 year typically. So no, I don't have any active loans with them.
I think we had another question following up about foreclosure on estates.
How many states are you in? Because I've got a lot of loans out, but they're all in different states. Ohio, I just use my own example. Ohio is different than Texas. Michigan's different than Ohio, so.
We lend in 30 states.
Pardon?
30.
Okay, so your loans are in 30 different states?
Yes.
We have local counsel in the markets frequently.
I had one quick question.
Sure.
What, I don't know if I've ever heard this term. 5K approval. You were talking about you want 50K approval or something.
You talking about accreditation?
Yeah.
Can you explain what an accredited investor is?
Oh, do you know this definition of accredited investor? This is a great, so if people knew this, there would be a revolt. There would be a revolt, so be careful who you tell. In order,
What do I do now?
the Securities and Exchange Commission, going back to the Securities Act of 1933, has ruled. If you want to advertise securities to the general public, put up a billboard, make a website, do whatever, then you must meet their definition, then you must register your securities. So that's when a company goes public or the like. And if you aren't going to register your securities, you can use a couple of exemptions. One of them is called Regulation D. That allows me to sell securities to accredited investors only, but I can't advertise. And I can't take money from non-accredited investors if I use that exemption. And that's how the vast majority of these private note offerings that go out to the clients of Goldman Sachs and other wealth managers, you guys probably see them from your wealth managers. Most people don't see that and don't get access.
What makes a person accredited?
An accredited investor is somebody who earns as a single person over $200,000 a year, as a married person over $300,000 a year, or has $1 million in net liquid assets, excluding the home. There's some other technical definitions for entities and the like, but that's the basic definition, and there are about 96 or 97% of households in America that don't meet that definition. And don't have RVs, they're not accredited. My son who invests on Groundfloor is not accredited. He's working on it. Lots more questions. I'll pick somebody got their hand up a little while ago. Oh, yes, sir.
How much equity does your borrower have to have, and how do you arrive at the interest rate you're going to charge?
So, Rich, would you like to answer that question?
Sure, absolutely.
The question for people in the room is, how much equity does the borrower have to have in the project, and how do we set the interest rate?
Right. So with regard to equity, our maximums are based on experience. So for our most experienced borrowers, they can borrow up to 90% of the cost or 70% of the after repair value. If you have less experience, it goes down to 85 or 80%. Actual, completed, verified flips or buy and hold. So we will ask you, if you tell me you have 10 deals, I will ask you to list out all your transactions, and we'll go back and verify. Yes, that's the entity that bought it, that's the date they bought it, that's what they paid, and that's what they sold it for. So we verify your experience, and based on experience, you get up to that much leverage. And then we have an algorithm that has essentially 6 inputs into it, experience, location, other things, leverage, and that's how we rate the loans from A to G. Every loan goes through the exact same process. The SEC requires us to have a uniform process to rate the loans and price the loans.
I'll elaborate on that just a little bit. On the platform, with each individual loan, the screen that Brian had up earlier, you're able to actually, look at the detailed information on that individual property. So you'll be able to see how much skin in the game the borrower has compared to what the loan value is compared to the after repair value. Also, the different factors that go into determining that grade, the A through G grade, and the interest rate associated, broken out. So you're able to make your own assessment as well. We, make that information available.
Great. More questions? Yes, sir. You're in the back.
So I've heard this characterization a couple of times. You guys aren't lending money to people with shaky credit who are Joe Sixpack and Sally Soccer Mom. This is for people who are flipping houses, people who are wanting to have a high-speed transaction, keep money going.
We make loans to entrepreneurs. We make venture loans to entrepreneurs who are in real estate. Now, sometimes people are just getting started and they've gone to a seminar and they've done a program, or they're coming up, and if they have a good piece of collateral and they bought it right and they have a good plan, then we'll back them. So we will take people who are new, especially if we can tell the difference between a first-time flipper who's going to make it and one who's not, and a deal that's going to work for them and one that's not. We've been doing this long enough. So we will extend to, newbies from time to time, but we really like the high volume, experienced people who work in a community and know the neighborhood.
But again, though, my main question, these are not people, you're not writing mortgages, you're doing short-term loans.
It is short-term loan, secured by the property. We look at the person, the plan, and the collateral in order to make a determination.
One other element to that, we technically, our borrowers are all entities, so LLCs or corporations, so we don't technically lend to an individual.
More questions? Yes, sir, in the back.
This would be for Adam. We have self-book control, self-directed IRAs with IRA-owned LLCs, so we have checkbook control. We do fix and flip loans on a regular basis. Is there anything unique to this kind of investment versus investing directly with a borrower?
I think it's just a lot easier, right? I mean, you're just way more passive. You're going on a website and just kind of clicking a few buttons. I guess the other aspect is there's less diligence on your end. You're trusting, in this case, Groundfloor to do the diligence for you. You probably also could invest less money. You can do a loan for a lot less money, get more diversification, because you could probably take your, let's say, 20 grand and I guess lend it out to 100 different properties, for example. So same concept. The interest is deferral back to your IRA. The LLC can make the investment, but you just get different options.
Yes, sir.
When we invest in your programs and you actually provide a loan, is that identified as a unique loan, or is it go into a conglomerate of the money pile?
I'm glad you asked that. This is an elegant structure that allows you to benefit from having only one 1099 IMT, as though you were in a pool, but for your results to be determined by the individual investments that you choose. It's something that in the world of securities law is known as a payment-dependent note. So you're actually investing in a note offering that is offered by Groundfloor as an issuer. But the terms of our agreement with you are that when the investments that you pick and choose on our website are what determine your return. So you don't get paid until the loan that you made for $10 or $100 or $1,000 actually repays, and you only get paid in the proportion that it repaid. So if it loses money, you lose money. So the pool is really yours. You get to define your own.
There is a time limit.
The loan is due, it's a loan, so it's due on a maturity date, and if it misses the maturity date, we're managing that. We usually know it's coming. We actually also issue updates every 30 days on your portfolio, so people who are interested kind of go check in and see what's happening. If one's going to be late, you know. But if people are sufficiently diversified, it comes out.
I can't compare you to a normal savings loan.
I wouldn't. Yeah, I wouldn't. We're not FDIC insured, and there's risk, and I have to say all these things.
Who are your competitors?
There is no competitor that allows individual investors to participate directly in real estate loans on an SEC qualified offering to the tune of $10 a flip. There's not one in the market. Now, there are lots of competitors who will let you invest in real estate or real estate debt. If you're an accredited investor, you can invest in Pure Street, like this gentleman up here. If you're an accredited investor, the world is your oyster. Good for you. But we think we compete very, very well with those platforms because we're regulated, we're disclosed, we're audited, we're like a public company.
Corporation?
What's that?
You're a corporation?
We are. We're a C Corp. And in fact, we have 3,200 shareholders. Many of our customers have decided to buy stock in the company as well. So we look and feel much more like a public company, which is a pretty big difference. There are non-traded REITs are competitive at some level, but this is the only one that really lets you retain the control. And I do think that's going to happen in more sectors. There will be more companies like Groundfloor in other sectors of our economy, in the private lending landscape. I think that's a great thing. Yes, sir.
What do you actually, those of us that would invest?
Yes, sir.
What do you actually call us?
What do we what?
What do you call us? Do you call us investors? Do you call us fools? What do you
I call you smart people.
What's the official?
Investors. You're an investor. You're an investor in our offer. What's that?
Not a lender.
I mean, you are a lender. I mean, you're lending us money, and we're lending it on your behalf. I mean, we've loaned it on you're participating in a loan. So you know, some people call you micro lenders. There's one Facebook group that is about Groundfloor where they call them funders. You're an investor.
We're an investor.
You have participated in an offering of investment securities. Yes.
So you would accept money from either an LLC or an IRA that's held in a custodian or
Yes.
an individual?
If you have checkbook control over your IRA, then that's facilitated with many investors who do that. And then we also increasingly are partnering with providers of these to be a qualified investment on their platform that they've
Is it
certified.
ever in individual's name or an investor be an individual?
Individual or an entity, yes. Yep. Any other questions? Yes, sir.
Groundfloor listed?
We are not listed, not yet. We have a public offering of stock under Regulation A, but we are still a privately held company. Privately held by 3,200 people, but privately held. So the shares don't trade. Yes, sir.
What year did you start business?
2013, exactly 7 years ago, Wednesday. Is when we. Our default rate, what do you mean by default? You don't mind me
How
asking?
many homes have you actually taken back, or had to go that far?
Our foreclosure rate is hovering around 1%, is that correct, Rich? I'm looking at Rich. It's about 1% for foreclosure rate.
If we had a 08 or 09 kind of bust, what would you expect would happen then? What kind of rate would you think would have higher rates during that period of time?
I'm sure the rate would be much higher. I think the maturity on these investments would extend much further. I'm sure that losses would be higher. No question about it. All right, they're telling me the time is up. We have lots of people with Groundfloor t-shirts who are here. Happy to be in Orlando. Can meet with you after the session, and Alyssa's there, and Larissa's in back, and our panelists, of course, are accessible to you. Thank you guys for joining us.